Here's something that surprises almost everyone. There is no application form for Hong Kong offshore tax exemption. No form, no government fee, no certificate on the wall. And yet, done properly, a Hong Kong company can legally pay 0% profits tax on income earned entirely outside the city. So, how do you actually claim offshore tax exemption for your Hong Kong company? You claim it inside your annual profits tax return. There is no separate application, and you win it with evidence. Proof that the activities producing your profits happened entirely outside Hong Kong. The burden of proof sits with you, not the taxman. In this video, the 5 steps of a successful claim. And step 5 is where most claims eventually go to die. So stay for that. Step 1. Check whether your profits are genuinely offshore before you claim anything. Hong Kong taxes on the Territorial Source Principle, Section 14 of the Inland Revenue Ordinance, Chapter 112. Only profits arising in or derived from Hong Kong are taxed. The test the department applies, set out in its practice note on the locality of profits, DIPN 21, is beautifully simple to say and brutally factual to apply. What have you done to earn the profits, and where did you do it? Remember that question. It comes back later. For traders, the key factor is where your purchase and sale contracts are affected, and affected means negotiated, concluded, and executed, not just signed. Picture a founder in London running a Hong Kong company. Suppliers in Shenzhen, that's the manufacturing hub just across Hong Kong's northern border in mainland China. Customers in the United States, goods shipped direct, never touching Hong Kong. That is the classic pattern. For service businesses, it's simpler. Where do you physically perform the work? And one hard rule: trading profits are all or nothing. Either the whole profit is offshore or the whole profit is taxable. There is no splitting. Step 2. Build your evidence file from day 1, not at filing time. The department does not take your word for anything. A successful claim rests on documents, contracts and purchase orders showing where terms were negotiated, emails and call records showing where decisions were made, travel records proving where you were when deals happened, shipping documents proving goods never entered Hong Kong, and bank records showing the money trail. This sits on top of the bookkeeping every Hong Kong company must already do, the books of account, source documents, and daily money records we covered in our bookkeeping video. Think of the offshore file as a second layer. Same discipline, pointed at one question: where was the work done? Reconstructing 2 years of evidence after the department asks is somewhere between painful and impossible. Collecting it as you go is almost free. Step 3. Make the claim in your profits tax return. Your first return typically arrives about 18 months after incorporation, and you have 3 months to file that first one. The claim itself is a disclosure inside the return with a supporting schedule, and this is important. Your financial statements still need to be audited. Every active Hong Kong company needs an audit, offshore claim or not. We made a whole video on that. Your auditor reports on the numbers. The offshore claim is a tax position built on top of them. The government charges nothing for making the claim. Your real costs are the audit and whatever professional help you use to present the claim properly. Present it well the first time. A clear, documented claim invites fewer questions than a bare one-liner hoping nobody asks. Step 4. Expect questions and answer them properly. The department reviews offshore claims rather than rubber stamping them. A straightforward, well-documented claim typically resolves in 3 to 6 months. A queried one can run 6 to 12. Enquiry letters usually give you 1 month to respond. And here's the pattern. Every enquiry letter is really that step 1 question in disguise. What did you do to earn this profit, and where? Who negotiated this contract? Where was this order solicited? Who arranged the financing? Answer specifically, consistently, and with documents attached. Inconsistency is the claim killer. If your answers drift between letters or contradict your website, your invoices, or your travel records, the review hardens. If you did the work outside Hong Kong and your file proves it, this stage is administrative, not adversarial. And step 5, the one I warned you about. Offshore tax exemption is not a trophy. It's a position you re-earn every year. Each year's return repeats the claim, and the department revisits accepted claims from time to time, so the evidence discipline never stops. Here is where claims die. The business quietly changes. You hire a Hong Kong salesperson. You start serving Hong Kong customers. You move negotiations to Hong Kong. Any of these can flip profits onshore, and the facts of each year decide that year. If you want certainty before committing to a structure, the department offers an advance ruling on the source of profits. The fee is 45,000 Hong Kong dollars, covering 23 hours of official time, with extra hours billed at roughly 1,730 to 2,650. Optional, most small companies simply file well-documented claims, but the option exists. Now the honest part. First, a rejected claim doesn't just mean paying the normal 8.25 or 16.5%. If the department finds profits were understated, penalties can reach up to 3 times the tax undercharged. Never claim aggressively. Second, offshore in Hong Kong is not tax-free everywhere. If you run the company from London, your home country may have its own view of where that company is really taxed. Get advice on both ends. Third, a newer regime introduced in 2023, the Foreign-Sourced Income Exemption regime, adds substance requirements for some foreign passive income, but it applies to members of multinational groups, not typical standalone companies. If you're part of a group, check before you file. And as we said in our 0% tax video, Hong Kong is low tax, not low standards. The exemption is real, for companies whose facts are real. The facts in 30 seconds. Hong Kong offshore tax exemption is claimed inside your annual profits tax return. No separate application, no government fee. The test. What did you do to earn the profits and where? Trading profits are all or nothing. Evidence is everything, collected from day one. First return. About 18 months in, 3 months to file. Reviews run 3 to 6 months or 6 to 12 if queried. Inquiry letters give you 1 month each. The audit still happens, and the claim must be re-earned every year as your facts evolve. At Captime Corporate Management Limited, we prepare offshore claims the way the department likes to see them. Bookkeeping that captures the evidence as it happens, audit arranged and tax filing under one roof, and inquiry responses drafted from your actual records. We're a licensed Hong Kong firm working with overseas founders and e-commerce sellers, exactly the businesses these claims are built for. If you'd like an honest read on whether your setup qualifies for offshore tax exemption, book a free 15-minute consultation at captime.hk or use the link in the description. No credit card, no obligation. Thank you for watching. Subscribe for accurate, hype-free guides to running a Hong Kong company. And see you in the next video.